David Wilson lives in a rural county that hasn't had a bank branch in over a decade. To cash his paycheck, he drives 45 minutes to the nearest town. With no convenient place to deposit money, he keeps cash at home and uses money orders to pay bills. "I'd probably save more if it was easier," he admits. But with gas and time off work, going to the bank feels like a luxury. Wilson is one of millions living in what experts call banking deserts, areas with little or no access to financial services. While digital banking is growing, physical branches remain essential, especially in places with poor internet access or low digital literacy. A study by economists Claire Salarier and Adrien Matray, published in the Review of Financial Studies, reveals that limited banking access fuels wealth inequality in America. When banking services expand, low-income households accumulate more wealth, invest in assets like vehicles, and become financially resilient. Counties with higher poverty rates had fewer bank branches, explains Matray, meaning those who could benefit most often have the least access. Financial exclusion has a distinct geography. The FDIC reports that about 30% of low-income Americans are unbanked, with even higher rates in rural and low-income urban areas. The research shows this is not by choice. When banks open branches in underserved areas, people open accounts and save more. Between 1994 and 2005, regulatory changes allowed banks to expand across state lines, increasing branch density by 20% in poorer counties. This created a natural experiment showing that easier access to banks improves financial outcomes. As banking services became more available, more households opened accounts, accumulated assets, and accessed credit. Households with bank accounts owned 5 times more wealth than similar unbanked families. They held savings in interest-bearing accounts, bought vehicles, and qualified for loans. Banked households were 56% more likely to own cars and invested about $5,900 more in vehicles, essential for commuting and better job opportunities. The research reframes banking not as a simple service, but as critical economic infrastructure, like roads or broadband, vital for participation in modern life. Policies should focus on structural barriers that create banking deserts, not just persuading individuals to open accounts. In economies with well-developed financial systems like the US, being unbanked is particularly costly, Matray says. Banked households also showed greater financial resilience. During job loss or income shocks, they were less likely to fall behind on bills or rent, benefiting both families and communities. Financial inclusion, therefore, builds stability as well as wealth. To address banking deserts, experts recommend stronger incentives for banks to serve low-income areas, greater support for community development financial institutions and credit unions, investment in digital infrastructure, and possibly postal banking to reach remote communities. The marginal returns to financial inclusion are high, Matray concludes. Expanding access to basic banking empowers people to save, invest, and weather hardship, creating a more inclusive and resilient economy where opportunity isn't limited by geography or income.